How you feeling about us as it relates to this sort of AI driving both the equity markets to all-time highs?
I think a lot of the AI stuff that's going on today obviously is around whether it's OpenAI or Meta or Oracle or Google. And there's clearly going to be winners and there's going to be losers. Growing up as a bond guy, thinking about rate and macro and, long, short things, can you say it feels a little bit heavy? The answer is yes. Could I be wrong? The answer is absolutely yes. I just think for our firm here, we're very late in that game and it just doesn't feel early at all. I hope it works for everybody, but it's something that we're definitely concerned about.
Walker and Dunlop brings you insights for life. Unique perspectives from impactful leaders. This is the Walker Webcast with Willy Walker.
Good afternoon and welcome to another Walker Webcast. It is my great pleasure to have Michael Nierenberg join me today. Michael is Chief Executive Officer of Rithm Capital. Mike, I'm going to do a quick background bio on you and then we're going to dive into our conversation, if that's okay with you.
Love it.
Great. So, prior to becoming Chief Executive Officer of Rithm Capital, Mr. Nierenberg served as Managing Director and Head of Global Mortgages and Securitized Products at Bank of America Merrill Lynch. Prior to Bank of America Merrill Lynch, he was at JP Morgan, where he was Head of Global Securitized Products and a member of the Management Committee of the Investment Bank. Mr. Nierenberg also held a range of senior leadership positions during 14 years with Bear Stearns, including head of interest rate and foreign exchange trading operations, co-head of structured products, and co-head of mortgage-backed securities trading. Mr. Nierenberg spent nearly 7 years at Lehman Brothers prior to joining Bear Stearns and was instrumental in building the company's adjustable rate mortgage business. Mike, quite the career, quite the journey with Rithm. Rithm, as you recall, when Newcastle was kind of spun out of Fortress to begin what you have created, CW was sold to Walker and Dunlop by Wes at the exact same moment. Mr. Cooper was spun out at the same time. New Seniors was held onto by Fortress for a period of time and then spun out as a public entity. Since that time, where Newcastle became New Residential, then you purchased Home Loan Servicing Solutions. Then you purchased a big portfolio of MSRs from Citigroup. You purchased Ditech out of bankruptcy. Then you acquired Genesis from Goldman Sachs in 2021. Then you terminated the Fortress management agreement in 2022. You bought $1.4 billion of Marcus loans from Goldman Sachs in 23. You bought Sculptor in 23 and then Paramount Group in 25. A lot in there. What, if you add all that up, Mike, what is Rithm?
It's a great question. Thanks for all that. I think when you go back in time and you look at all the stuff that we've done, it says one thing about me is that I'm freaking old. But it's been a great journey for us. Rithm, the way that I like to think about Rithm is, and to your point, we started this thing at Fortress going back to 13. There's a lot of great vision by Wes and some of the other folks actually to create some of these different permanent capital vehicles. And then we actually took the ball and ran with it and acquiring a number of different companies, which over the years gave us the ability to create what I would call a scaled asset management business. And that, quite frankly, and a lot of that happened while acquiring a number of these different assets, which enabled us to grow earnings at the REIT level. And then, as you pointed out, in 23, when we acquired Sculptor, and 25, when we acquired Crestline, and we did a number of other things in between. Today, if you look at the company, we have roughly $8.5 billion of permanent capital. Not many folks can talk about that size of permanent capital. The assets that we manage on behalf of third party and balance sheet now is $110 billion. So when I look at us, we're $110 billion of assets. $8.5 billion of permanent capital. We have a company that hopefully makes north of $1 billion in pre-tax earnings. And, like I like to say on every earnings call, we're not Blackstone. We'll never be Blackstone, but I think there's a lot of room for us as we continue to grow our asset management business. So really, taking a step back, when we bought the management contract back from Fortress in 22, the goal was actually to diversify our earnings and our income stream. So we weren't just, we built a big residential business leading up to 22, but obviously we all have a lot of experience in doing this for, as I referred to myself as being old, but for many, many years, we thought it would be a great opportunity to diversify income streams. And that's why we launched our so-called ventures into both commercial real estate and asset management. So today, I like to think of us as an asset management business that operates under the, kind of the tax advantage nature of a so-called REIT, which, quite frankly, from an equity perspective, is not really helping us when you look at the way we're trading today.
Yeah. I love the video of you ringing the bell when you guys went public 3 years ago. And it was obviously a joyous day. And I think about that as it relates to all that you've created and kind of the culmination of that journey. I guess the question I'd have is asset management writ large makes a lot of sense, but there single family lending and assets, there's commercial lending and assets, there's consumer credit card assets and lending. Given the breadth of it, Mike, what's the kind of where do you really get the opportunity to differentiate? Because both of us operate in wildly competitive markets as it relates to why someone would come to you or come to me for capital. And given the breadth of your platform, I get it from a diversification standpoint. It's obviously great when resi's sucking wind, commercial's doing well, when consumers doing well, resi's, whatever the case might be. Great from that standpoint. But as it relates to just sort of your value add in either the lending or capital deployment strategy?
So it's a great question. If you look at the company, and again, we go back in time to 13, we started by taking advantage of a dislocation in mortgage servicing rights. And that's really how the company got started back in 13, resi based. We acquired obviously hundreds and hundreds of billions of mortgage servicing rights along the way. Did a structured deal with Aquin. We bought HLSS, which was a kind of an Aquin spinoff. When you look today in the different asset classes, think about so-called ABF today, which has never been more popular, which is asset-based finance. And when I look at what we have here, we really have a world-class asset-based finance business. That will be a little bit different than what I would say on the commercial real estate side. But when you look at our expertise around the house, whether it be myself, who's been doing this for 35 plus years, you look at a lot of us that have been together for 30 plus years. One of my partners here, Charles Sorrentino, that's how he cut his teeth growing up in the asset-based finance world. And it is one of the most highly demanded products, I would say, from LPs today. And when you look at our track record in the public markets from an ROE perspective, as well as both Sculptor and Crestline, I think we tend to punch above our weight when we think about returns. So when folks are thinking about deploying capital in that space, why not here? The commercial real estate space was a little bit more opportunistic in nature, is what I would say. Doing the Paramount deal, when we got a call from our banking friends at B of A, and in towards the summer of last year, I think it was, about a potential sale of this company, Paramount, we said, okay, let's take a hard look. Office has gotten crushed. A lot of folks have gotten hurt, unfortunately, being long office. And we said, okay, we're going to continue to try to grow our commercial real estate presence here at Rithm. And that's why we took a hard look at that. But we look at it as a different business line, I think, more so than what I would say on the so-called ABF space. Where we ultimately go with this is we're going to simplify our story. If the asset management business was large enough, quite frankly, we would turn around and, we'd likely either list that separate from the overall REIT. How do we think about de-REITing in light of how our equity trades? How do we think about bringing the mortgage company public, on a company that makes $1 billion a year and that we started from scratch? There's a lot of those things that are going to come into play here, I think, over the course of the next 12 months.
And as it relates to aggregating assets, Mike, kind of, given all of the acquisitions that you've done and the very, demonstrable success that you have had in raising capital to then go and purchase assets, um, how much is a sort of B2B business versus a B2C business?
I think it's a combination of both, right? When you think about our mortgage company, for example, we service over 850 billion in mortgage loans, almost 900 billion in mortgage loans, have north of 4 million customers. We're making a big push around the marketing and branding of that company, which is known as New Res. You pointed out before we built Mr. Cooper while at Fortress, and then we sold that to KKR in 18/19. We built One Main, sold that to Apollo, and again around the same time, all while building out this new vehicle or this new mortgage company called NewRes. So I think when you look at that, there's a huge consumer component of it. When you look at the Paramount deal, Paramount is effectively, when you think about it, the tenants they're real businesses. You have some of the top law firms in the world. You have some of the top music companies in the world occupying different buildings, real estate companies, et cetera. So I think it's a little bit of a combination of both. Our goal overall is how do we create sustainable earnings in each one of our sectors? And this is going to lead into the asset management business. Take those cash flows that we create or take those earnings that we create and then somehow have the market think of us as an asset management business that trades in a much better multiple than where the so-called REIT trades. Today the REIT is, we made over $400 million in the fourth quarter of when we announced earnings a week and a half ago. There was a couple misses on one of the mortgage companies out there, but when I look at what we built, it's really how do we create, again, sustainable earnings that get valued like an asset management business? And this goes back to your question. We need to grow our asset management business, or also known as our fee-related earnings. As we do that, I think we're going to see a much different valuation for the company.
As you talked about, investors really like asset-backed lending today. You're clearly in a lot of different pockets. I'd love to get your thoughts as it relates to the strength of the consumer. You talked about commercial real estate and clearly the downdraft that has been on office, and feeling like you're stepping in probably at a good basis there on the office assets that you stepped into with Paramount. Talk for a moment about the consumer, and you bought a big portfolio from Marcus, and you've been in the consumer lending space. A lot of people sit there and say the U.S. consumer is, stretched out, and credit card defaults are on the rise, and that it's a K-shaped economy. Give me Mike's view of the U.S. consumer today as we begin 2026.
Sure. So clearly we have a lot of data around the consumer when you look at our mortgage company, right? I pointed out we service over 4 million customers there. I think what we've seen is, in general, performance has been very, very good, a very, very healthy consumer. Clearly, there's going to be blips as you go into year end in the mortgage business. You're going to see folks that may allocate, instead of paying their mortgage, they may need that for gifts or something like that. The administration's come out with a couple different new programs, particularly on the Ginnie Mae side, where we saw a spike in delinquencies where we're up, call it 1.5% to 2% over the course of the past couple months. And what's happening there is the mortgagor needs to be current, as you think about working with a mortgagor for 3 months in a row, where going back over the course of the past year or even before that, they needed to be current for 1 month. So when you think about it, there's a few changes into some of the government programs, but in general, I would say the consumer on the mortgage side, from what we see, is very, very healthy. I think there's been a lot of noise around the market with First Brands and Tricolor, and most recently there was something called Perch that has brought a bunch of negativity to the so-called the consumer side or the asset-based finance space. I think those are, I think they're more isolated. While saying that, we all need to be extremely careful here on the lending side. But I think in general, the consumer is fairly healthy. Obviously, the subprime consumer, when you think about subprime autos and things like that, those areas are a little bit more isolated, as we know, going back to our fortress days, as we were building One Main. One of the things we did in 13 is we bought $4 billion of consumer loans, which quite frankly have performed amazing, and that goes back in time. So in general, what I would say is the consumer seems to be on very good footing. The lay person, as who we all are, you go to Starbucks and you get a cup of coffee at $6 or whatever it costs. So clearly there's a bunch of inflation that's out there. And the question is, at some point, do you see tariffs weighing in on some of these companies, which are going to see price increases, which are going to affect the consumer negatively? And that's something that we are highly focused on. When you brought up Marcus, when Goldman announced they were getting out of their so-called consumer business, we bought half the portfolio of Marcus loans. What we saw on that is north of 700 FICO borrowers. It's paid down to next to nothing. That was done a few years ago. What I would say our experience on that one is, if there's not brand recognition or a servicer that a consumer can look to, your performance overall is not going to be great. On that portfolio, I think we underwrote it to something between an 8 and 10% cum loss number. That's kind of the math that we saw in that. So what I would call fair performance at best. But there's other consumer businesses, as we all know, that we look at and work on. And if the servicing practices are great, I think you're going to find your performance is going to be much better than some of the performance stuff that we saw on the Marcus portfolio, because Goldman was getting out. And from a servicing standpoint, if a borrower missed a payment, it's hard to get them back after 30 or 60 days if it's not your servicing entity. And I think one of the messages I would get out of this podcast is that, in the so-called ABF space, if you can control your own destiny via servicing, it's a huge leg up versus someone else who's just going to buy an asset in the marketplace.
You spent a bunch of time both as a very senior executive as well as on the board of major investment banks. Buying the Marcus portfolio as Goldman was in wind down on that business. I'm interested in your perspective on when Goldman decided to enter the consumer business and Morgan Stanley went into the really kind of Gorman put the full speed on as it relates to private wealth management and their asset management business, if you will. A decade after the GFC, which drove those decisions, pretty clear that Morgan sort of won, if you will, versus Goldman. And yet at the same time, the Goldman franchise has done extremely well from an overall valuation standpoint. Anything that you look at as it relates to that kind of moment where Morgan Stanley went one path and Goldman Sachs went the other path? And in hindsight, obviously we can see how it all played out, but what was either risky on one or didn't work out on the other that you can look back on?
Yeah, it's a really good question. You look at what Morgan Stanley's done, and they've built a fantastic franchise around their wealth business. And it goes back many, many, many years. So really kudos to them. They stayed away from a lot of the so-called consumer stuff that you referenced that Goldman did. The one thing I would say, and Goldman is they're both close counterparties of ours, and obviously some very senior relationships with the Goldman folks. I think they have done a fantastic job with that institution. One is their client franchise is second to none. Two is, as you think about the consumer space that they entered, then they decided to pull back. When you look at real earnings and the vision around the firm today and where Goldman's going and growing their wealth management business, I think the leadership of that bank has done a great job pivoting from where they saw a potential opportunity to say, you know what, maybe we're not right here. Let's refocus our efforts. But I'm not sure that the consumer efforts were in lieu of the great job that I think they've done around their so-called wealth business and working with clients. And I grew up in the business. You pointed out some of my Bear Stearns days. We were all fierce competitors, and whether it be Lehman Brothers and Bear Stearns and Morgan Stanley and Goldman and stuff. I think certain firms were viewed as more friendly to what I would say their customers when you think about people borrowing money from the banks today. Goldman is just a top franchise in most LOBs in what we all do for a living, and so is Morgan Stanley. So kudos to both of those folks for doing a great job. And I think in the case of Goldman, they just pivoted it, and said, okay, this might not have been right. They had Green Sky, they sold Green Sky, they had the Marcus loans, they got out of that, and then obviously Apple Card, I think, is now with JP.
The Apple Card is with JP. Now that's an interesting statement. Let me double click on that for a second. Just because of the breadth of the commercial bank along with the investment bank.
Yeah, I think it's probably more in the commercial bank. I don't, again, I think, the banks have done great. And, I think the discipline around credit quality and working with their so-called customer base and banks have done a great job. I think when you look at, JP Morgan and you walk around, whether it's New York City or somewhere else, and you see these great branches that they have, and you think about the power of that franchise and, look at 270 Park and, and the great job that Jamie and the team have done building that, kind of fortress style building. The banks have done great. I think as it relates to doing more with high quality customers in the case of the Apple Card, I think my guess is that's the way that they were viewing that.
And so do you see increased consolidation there where the big commercial banks have to continue to, sort of gobble up the investment banks, and being a standalone investment bank sort of has a limited shelf life, if you will?
Yeah, I think you've seen that, and you've seen the consolidation. Obviously, Santander just announced the acquisition of Webster Bank.
Yep.
Webster Bank has been out there for as long as I've been in the business, and and now they're part of Santander. I think there's a large movement to acquiring customer type franchises, and in so-called different geographies. And I think with a more friendly administration, which you have today versus years past, I think you'll continue to see probably more consolidation in the banking industry.
Thought it was interesting. I listened to an interview that Ana Botín, the executive chairman of Santander, had after they'd done that acquisition, and she said that the Webster Bank footprint is as big as the UK market. And I
Yeah.
just every once in a while we kind of forget about the scale that we have in the US versus someone who's been in the European market and might have great market penetration in the UK and in France, but if you add it all up, it's actually not a whole lot in comparison to what you can get being here in the US.
Yeah, no, for sure. You look at some of the business lines, and we all look for different ways to drive earnings. And you go over to Europe. I mean, the markets are generally on the smaller side. Interesting, but more on the smaller side.
Yeah. SFR, you've invested there. The president came out saying that he wanted to pull institutional capital out of single family rental. Kind of what's your take on that? And do you think that the carve out on build for rent allows you to continue to lend in that space? Or is it kind of a pretty significant shift given where the administration is headed on SFR?
So we own a few thousand homes. I think we own a total, give or take, about 4,000 homes that we've acquired a few years back, more on what I would say the scattered side. And then we have, we own a couple what I would call developments in the build to rent space. I think as it relates to us, it's, we have a couple $100 million of equity tied up in that business. It's not a sustainable, the way that we view it from our perspective. And I'll point out from our perspective, I think it's a very, very hard business. You need to buy cheap assets. This business got started, and the way that I think about it going back, I think my guess is something towards just after the financial crisis, when Blackstone started buying homes on the courthouse steps. And I remember having a lunch with John Gray, who was talking about cap rates on single family products at that time. And I think that's how it got started, thinking that your baseline or your base rate or downside was, give or take, let's just say, a 6 cap rate. When you look at where we are today, we're give or take back at that 6 cap rate. There's been HPA going back to just after the financial crisis, significant HPA. Today, we got out of buying homes years, probably 3 years ago because the math didn't work. Everything was upside down. Your cost of capital was higher than where you could actually deploy capital. So we're not a large player there. We'll be selling, we are selling down our exposure there, more through retail, but we just don't have a lot. What I think from an administration standpoint, and obviously there's a lot of tape bombs that go off coming out of that administration. When you think about the institutional buyers, they're overall, as it relates to the total share of single family transactions, it's give or take something around 1 to 3%. So I do think it's an important business to keep, the housing market functioning. While saying that, I think the government is going to focus more on scattered homes than they are going to be focusing on what I would call build to rent communities, where you'd go out and buy 300 homes from Lennar, who's building something in the middle of Texas. So for us, it's not that relevant. I do think that business has just come to a grinding halt at this point. I think the math may work, based on SOFR being 3.5% and cap rates in and around 6-ish%. But it's a tough business. I think the newer home stuff with the big builders selling forward will be okay at some point down the road. But right now that business is at a halt. And for us, it's just not that relevant. My general view is owning scattered homes and collecting rent is just not that easy.
And by the way, your lunch with John Gray reminds me of being at Sam Zell's conference back in probably 2013, where Colony and Blackstone stood up and talked about buying single family homes. And Sam said, anyone in the room ever washed a rental car? And everybody in the room was like, nope, never done that. And he was like, these assets are going to be impossible to maintain. And why would you ever go into them? And lo and behold, both Colony and Blackstone made a great business out of it.
Yeah.
Broaden that out, Mike, for a second, as it relates to single family and multifamily. In your view of housing, the Trump administration clearly has been trying to bring down the cost of housing in America. Multifamily rents have been basically flat for the past 2 years, even though the CPI seems to be getting an erroneous print that we've actually had significant rent growth in America, even though it hasn't actually been in the rents that at least at Walker & Dunlop we see.
Yeah.
And you also have the administration putting pressure on the single family home builders to go and build more homes so that we can bring down the cost of entry level housing. You're making bets every day as it relates to lending on the single family side, lending on a multifamily loan. What's your take on just sort of housing across the various, if you will, asset classes?
There is, if you look at the single family space, there's a big shortage of housing. That's been out there for many, many years. While saying that, you're at a period of time when, mortgage rates have definitely come down a little bit when the government announced when the administration announced that Fannie and Freddie would be buying upwards of $200 billion in mortgages. We think they bought it, and I'm not 100% sure, but something in the vicinity of 50 billion so far. They do have caps, I believe, for 26 of about 150 billion that they could actually acquire. Since they announced that, mortgage rates have dropped probably 15 to 20 basis points, while on the other side, the 10-year treasury is give or take about 4.2%. So rates really haven't moved. Mortgage rates have come in a little bit. We're seeing a little bit more refi activity. I think that's healthy for the so-called consumer. I'm still of the opinion, when you look at what things cost in our lives, where I don't know, I'm not the huge bull on home prices and home price appreciation, to be totally honest. And this is my own personal opinion. But I do think that the housing market is in reasonable shape. I think people do want to own homes today. The government is going to continue to do all they can to drive the cost of homes or the processing down. I do think there's ways they could do that. When you think about, for example, title insurance, title insurance is a big nut on anybody that buys a home. There's got to be a better way to do that. And, I know a lot of the recording of a mortgage sits with the county, with the local counties. There's a different way to do that. In my opinion, that could save homeowners a fair amount of money. So while the government wants to continue to drive affordability into the system, which, I think we could all appreciate, I do think it's a heavy lift. It's no different than being able to control the outcome. We talk about yield curve control from coming out of Treasury. These markets are massive. The housing market, I think, in general, though, is in good shape. I'm not the huge bull on prices, but I'm not hugely negative. As it relates to the multifamily space, one of the businesses we have, and we make loans there, is we have a business called Genesis Capital. It's based out in California. It makes about $5 billion a year in loans. A lot of those are made to what I would call mid-tier sponsors that are builders, as well as we do a fair amount now in the multifamily space. We do some ground up construction. What we're seeing there is still very, very good performance. I think all of these businesses, and this is where I get a little bit concerned with the growth of so-called ABF and thinking about lending, just making sure lending standards are extremely, I'm not going to say tight, but the underwriting process is extremely robust. So there aren't hiccups in the system. But in general, I'm constructive on, I think multifamily, you're going to continue to see more and more demand, obviously, for around the multifamily space. I'm not hugely bullish on prices. Credit quality is really going to matter as we go forward. And I think the administration is going to do all they can to actually lower the cost of housing. While saying that, obviously we know the rent stabilized stuff is a little bit more challenged these days, particularly in New York City with the new mayor.
Jobs reports coming out on Wednesday. A lot of people trying to sort of figure out whether we're sort of stagflation as it relates to job growth, even though GDP growth is cranking along. Any concerns on your part, given the consumer businesses that you're lending in, as it relates to jobs and the unemployment rate?
I think they're calling for 70,000 or something on Wednesday. There's some, I guess there was some B of A piece that came out where they're a little bit more concerned with a higher print. I think, listen, there's so many cross currents and so much negativity. I think a lot of times in the news, even when we talk about AI and AI taking jobs, and I had a banker come in here for lunch today, and we're talking about the macro environment and how we think about office, and how AI is going to take everybody's jobs, and what's our gut feel on that. You watched the Super Bowl yesterday, you have AI, all the different commercials around AI. The one thing I would say around AI is you're seeing a huge movement of folks back to the office, including in the AI space. Anthropic just took over a whole building in San Francisco. So, I think on the job front, I'm not negative. We all want to get more efficient. I do think AI will take some jobs, but there's always going to be another industry created out of that, and you do need people to do the work. So, I think we're reasonably constructive.
I would add, I thought that all of those AI ads were pretty lacking as it relates to any fun, or yesterday seemed like a flub as it relates to Madison Avenue on coming up with some creative concepts to sell products. That was my take. It was kind of a boring game and a boring ad day, but anyway.
Yeah, most of them were really bad, actually. You go back in a number of years ago where everybody was so excited for the ads, and it just didn't do it.
Yeah. So if you're not concerned about jobs, what about the amount of capital that's going into AI? There's been, obviously plenty of conversation that we're in sort of an AI bubble. You were around and very prevalent in the dot-com bubble. You were very prevalent heading into the great financial crisis. You were running your current firm when we went into the pandemic. So you've clearly had your white knuckle days, Mike. You have incredible insights into both when you're feeling like we might be a little over our skis, when you feel like we're properly balanced, to use that analogy. How are you feeling about us as it relates to this sort of AI driving both the equity markets to all-time highs, and then the amount of capital that's going out to building this infrastructure that's going to drive this revolution that we're all expecting?
Wow. Here's what I would say. I think a lot of the AI stuff that's going on today is around the, whether it's OpenAI or Meta or Oracle or Google. And, there's clearly going to be winners and there's going to be losers. in our careers, if we take a step back and think about $40 billion projects, I'm not sure how to process that. And it's not.
Nor am I. Nor am I. Just as a quick aside to that, we have a team that's in the data center financing space, and I'm meeting with one of the big data center companies, and I said, for us to go in and add value when someone's doing a $3 or $4 billion deal is a little tough. They're going to go and syndicate, and we can put that together, but we're not really playing in that space. He goes, Willie, we're doing a $31 billion project right now. What are you talking about, 3 to 4 billion? And I was like, okay, I shouldn't be at this luncheon.
Yeah, no, it's the amount of capital that goes in. I think the one thing in the so-called ABF that should give people a little bit of comfort as you're making loans there is, you got to believe in the counterparty or not. If you don't believe in the counterparty, you shouldn't invest in this stuff. And I was looking at I think it was Meta's earnings that came out either last week or the week before, and I think they did 90 billion of revenue in a quarter. The numbers are staggering. These revenue numbers. While saying that, I do think AI is here. I think it's real. I think you go on ChatGPT and type in an earnings report. The good news is we don't need to. They don't need us to write our script anymore. I'm only kidding about that, but in all seriousness, you could do that and have ChatGPT or one of these other AI companies write your script. So I do think they're real. I think the amount of capital going in is just astronomical. I think the counterparty risk really matters. I hope we don't have a hiccup, but I think somebody told me today, I think it's a $30 trillion market or something like that. And trillion is just a big number in our lives.
Does it
So
concern you that a lot of them are doing it off balance sheet? I mean, like if this was so important to them and the future of their companies, why are they doing it all off balance sheet and with other partners?
yeah, I think they obviously they're going to need the capital. I don't have what I will say is on the credit side, that's really where I get concerned around some of this stuff and the sheer size. I also think the other thing is, when you brought this up, like the amount of people that you need to build these projects or whether it be turbines to power a data center. We spent a little bit of time with some of our old Fortress partners around the building of some of the data centers, going back to last year. Like the amount of capital needed, the amount they say picks and shovels or turbines, are just, it's incredible, whether it be capital, whether it be product, or whether it be people to build these different facilities. And then somebody says they have a data center field or something like that. Next thing you know, it's worth billions and billions and billions of dollars to whoever owns that. So I don't know. I'm being being a bond guy, growing up as a bond guy, thinking about rate and macro and long short things. Can you say it feels a little bit heavy? The answer is yes. Could I be wrong? The answer is absolutely yes. But I just think for our firm here, we're very late in that game.
Yeah.
And it just doesn't feel early at all. So I hope it works for everybody, but it's something that we're definitely concerned about.
And sort of talking for a moment, Mike, about in a previous world where you were running FX trading and a bunch of other big platforms. One of the things that gold has seemed to confound a lot of people recently, where you're sort of a risk-on bet on the markets, and then gold at being at all-time highs. After I talked about that with Peter Linneman a couple of weeks ago, a buddy of mine wrote me and said, well, the change to the capital rules to allow banks to hold gold and not have to put dollars against it has been a big driver of the run up in gold. And we obviously saw gold and silver back up quite a bit last week.
Yeah.
I guess the question would be this: how do you make sense of that risk on play on the equity markets and what would appear to be a risk off play on gold and the appreciation in gold?
Yeah, I guess the question I ask is gold at 5,100, it's 5,098 now, is that really risk off? Silver at $83, is that risk off? Copper's a little under $6. Bitcoin is, Bitcoin's given it up a little bit. I would expect at some point, if Bitcoin does continue to roll over, and I don't know if it will, quite frankly, does that lead into gold coming off? I think a lot of this stuff is pure speculation when you think about, some of the friends we may have in some of these markets that have just absolutely tonned it by being long some of this stuff. Um, you know, I am I don't I think there's so much speculation in the marketplace, even when you look at the Dow, right, at 50,000, and I think the S&P is trading what at something close to 25 times earnings, which is not historically cheap. You look at credit, which, the high yield index, and there's crack, everybody talks about whether there's cracks or not in credit. High yield index trades at 300. Wides are probably close to 1,000. Tights are probably close to 200. You look at the mortgage basis, which trades in and around 100 now. There's not a lot of room for error, I think, in any of this stuff. And then when we talk about, some of the data center stuff, and we think about AI and these big spends, I'm not am I concerned? Yeah, I'm always concerned. Do I think we're in a bubble? I don't know. I really don't know. But it's one of these things that I am a little concerned about.
What would make your concern meter go up? What would be the thing that you're tracking that sort of says, well, if I saw this happened, I mean, you've been, I guess, unfortunately for both of us, we've been around and seen a lot of these things. Second of all, you've been very much in seats that in hindsight, you can look back and say, hey, as we were looking at that, if that had gone there, or we'd seen that, maybe we would have reacted a little bit differently. Is there anything that you're looking at right now that sort of says, I'm relatively copacetic, but if that were to move there, that would be something that would put my antenna up a little bit higher?
Yeah, I think we got to monitor credit. One of the things that we're different about today at Rithm is, we bought this company called Crestline in big direct lending business. We closed on that in December. We have Sculptor on the credit side. We have 40 billion of what I would call real credit in the house, that we manage for other folks. So really keeping a tight eye on credit there, keeping a tight eye. And yes, you asked the question earlier about the consumer, making sure that because we get a ton of data, as do you. And if we look at data around the consumer and we start to see that roll over, that's going to be a sign that's going to get us a little bit, more defensive, I think, as we go forward. But the one thing, and then the other thing that gets me a little concerned when we look at the so-called ABF space, and everybody in the world on the asset management side is now raising funds around ABF, that's going to drive spreads in, that's going to drive returns lower. And at some point, it becomes a self-fulfilling prophecy where people are going to do what I think are going to be not wise decisions, which will affect the markets negatively. So those are kind of the things that we're going to keep our eyes out for. Some of the what I would call the momentum trades, whether it be gold, whether it be silver, whether it be Bitcoin. Bitcoin is trading 71,000 now, right? It was what, in the 120s, I think. I don't really know how to think about it. I think it's here to stay. But it's something that, we saw it. I think back to some of the discussions I had with some of our old Fortress partners where, it was at 3,000 and then you look, here it is at 125 and today it's at 71,000. So I think the momentum trades are a little bit different, but keeping our eyes on credit is something that's very, very important. Not only just in the credit markets, but also in the underlying consumer.
Final question for you, Mike. As you and your partners sat around at the beginning of the year and talked about what you're going to see in 26 and kind of bets you think are going to materialize in the year, sort of the, kind of the theme conversation that you would have sitting around the table saying, what's the theme for 26 and where should we either go long or where should we go short? Anything to share as it relates to what Rithm thinks are the places to go from an asset back standpoint or anything else in the credit markets or on the lending markets?
Yeah, I think on the on the listen, I mean, obviously we made a large play in commercial real estate around office. I think that, when I would say some of the longer term holders clean up some of their stuff, I think it's, you're talking about cap rates. We entered that deal at 7%. So that's more of a strategic play. When I look at lending in the ABF space, I like the lending side a lot more than I just like, us getting long assets here. Because I think you can control your underwriting, a little bit better. But like I pointed out in my earlier comments, with a lot of folks actually just marching towards ABF funds. You're going to see returns. Some folks are going to try to drive returns into the single digits. And yes, while that's a good place to be relative to what I would say some of the direct lending we see where there's demand, where you're starting to see a reallocation from direct lending into ABF space because it's cash flow backed by real assets. We just have to be a little bit careful there. I'm gonna tell you that I would rather be a little bit more cautious as we go through the year than probably we've been in a couple of years past. We've seen credit spreads tighten everywhere, including in the mortgage market. Underwriting gets me a little concerned. The lending side we like a lot. Congrats, by the way, forget about us. Congrats to what you guys have done. You've done a fantastic job in your business. And, I remember back in the day when Fortress was part of your life. So where you were and where you are today is just a remarkable journey, and kudos to you. But I think we'll be a little bit more defensive this year than we probably have been in the past couple of years.
Well, I know you will. I know you will continue to grow and aggregate assets and continue to make a great success of Rithm and everything else that you bring into it. Mike, thank you for taking the time. I love getting your perspectives on the markets. I'm really super appreciative of you spending the time to share your thoughts, and I look forward to seeing you sometime soon in New York.
Sounds good, Willie. Thanks so much. Thanks, everybody. Have a great day.